For anyone who cares about maximizing their investment returns, I think there's a variety of different factors that we consider. Of course, one of them is just purely what is our upside and what is the return that we're likely to make, right? The probabilities. Another is the downside. But one of the things that probably does not get enough attention is tax. So today we're going to discuss the subject of, have you considered the tax consequences of your investment and what is the tangible consequence of that in terms of real world numbers? And therefore, what can we do to plan to mitigate those? I'm going to give you a few suggestions at the end about what you can do to structure, almost no matter where you live, to optimize from a tax standpoint. And so stick around for those. If you haven't already, before we get started, please hit the subscribe button, hit the notification bell, make sure you don't miss out on any of our future videos. We try to produce great content for you every day. If you have something you'd like to see, please let us know in the comments. We'd love to create whatever content would be useful for you. And if you have at all questions about these subjects, about how to structure yourselves internationally to get the lowest legal amount of tax possible, we'll help you kind of figure out what is best for you. There's no one size fits all. And so happy to help kind of navigate that for you. And then if you're interested at all in setting up the structure, so forming companies, opening bank accounts, as well as getting residencies and citizenships, including unofficial citizenship programs, please reach out to us. You can book a call with me, clarity.fm/Michael Rosmer. There's a link below in the description, or you can check out our websites, offshorecitizen.net, offshorecapitalist.com. All right, let's dive into it. So first of all, I just want to kind of give some math to put some context around the importance of investing, because I run into a lot of people, clients of mine, who do quite well. They make a decent amount of money and they're not investing, okay? So here's the simple kind of way that I would contextualize it. Let's say that you saved $60,000 a year every year for 30 years, okay? Now, if you add this up, this is $1.8 million. Not a substantial amount of money for a lot of people, and certainly far less 30 years into the future, okay? On the flip side, let's put on our thinking hat and say, what if we were to earn 20% per year on that money for that same 30-year period? How much money would you have instead of 1.8 million? So some people will say, I don't know, maybe like 10 million. The answer is $99 million, okay? Now, 20% is an aggressive number to get, especially over 30 years. However, that being said, it goes to show the importance of putting your money to work for you, right? That dollar that you're earning, one of the things I kind of sometimes think about is I say, hey, listen, if you're earning X dollars per hour and you're able to invest that money and you allow it to grow, let's say it quadruples over the course of time, which is not an unreasonable expectation over, let's say, 20 years, right? It's basically like you earned 4 times as much per hour. And a lot of people will fixate on trying to increase their income while missing out on this other way they can multiply that income. Okay, so I certainly encourage everyone to obviously have some sort of cash around, but aside from that, make sure you get out and you allocate your capital to get it working for you, because it can make a really, really big difference over time. Now, the context around this is, what about how do we look at the tax consequences? And I think a lot of people look at the headline rate of what they're going to earn, or what they think they're going to earn, as opposed to the after-tax rate. And really, there's kind of the old adage, which is it doesn't matter how much you make, it matters how much you keep, right? Which is part of the thing on this channel. We talk lots about tax, and in particular international tax. So let's get into this. I'm going to give you kind of the somewhat erroneous or somewhat misleading Tony Robbins numbers, but I think it serves to illustrate the point in kind of like a macro way. So let's just imagine that you could invest $1, okay, and double it every year for 20 years, okay? So 1 becomes 2, becomes 4, becomes 8, et cetera, okay? If you stretch that out, and obviously you're not going to start with $1 and you're not going to double it every year, but bear with me in terms of just the numbers to demonstrate the point here. Imagine that you did that. How much would you have at the end of 20 years? The answer is you would have a little over $1 million. It's about $1,048,000, okay? So, this is quite a lot of money relative to a $1 investment, certainly. And again, obviously you're not going to do that kind of return, but anyway, that's how it's a little bit misleading. But it helps to put in context. Now, if we say, what if you were taxed at a rate of 33% a year, okay? Or 33% per doubling cycle, okay? So in other words, 1 becomes 2, so I gained 1, right? Then I get taxed on that gain at a rate of 33%, so I have 1.67. Then I double the 1.67, then I get taxed on the gain of the 1.67, and so on and so forth. At the end of the same 20-year period, how much money do you think you have? Now, a lot of people are going to say, I have no idea, etc. I'd really kind of like challenge you to think about it. Just think to yourself, okay, well, I would have had $1 million this way. How much would I have if I was taxed along the way? And now, it would be logical that somebody might say, oh, I'm going to have $670,000 approximately, right? Which is a million less 330,000, which would be 33% of a million, right? The answer is much lower than that, right? And some people will say, of course, it's going to compound. So, okay, I don't know, maybe you'll have 300 grand, right? No, it's lower. 200 grand, no, lower. 100 grand, no, it couldn't be much lower than that. Yeah. The answer is $28,000. So the cost of that tax over time, because of the compounding effect, adds up to like over $1 million, right? And that's a big deal, right? Really, really big deal. So it's one of the things I used to do the math back in the day looking at permanent insurance and comparing. You'd get maybe a 5.5% interest rate over the lifetime of the insurance policy. And somebody would say, well, that's not that exciting. It's like, yeah, but it's also non-taxable, right? And if you consider that it's non-taxable and then you compare it to a fully taxed return in an environment where people are maybe paying 40%, well, you would need to make 9% a year to get the equivalent of that 5.5%, right? So I think it's really important as you do your tax planning, or your investment planning rather, to plan taxes around it. And this may actually determine where you want to invest, right? If you're sitting there looking and you're saying, okay, hang on, I'd like to invest here, this is a good investment, but investing there means I'm going to pay 30% tax, whereas normally I'm not exposed to those taxes. Well, that may make it just not an attractive investment, right? So as you go and invest somewhere, it's really important. And I think this is especially important for people, say, looking at, maybe you're a foreigner who goes to invest in the US, right? Maybe you're a foreigner who goes to invest in UK. Maybe you're a foreigner who goes to invest in France or Spain or something like this, right? This can have a massive erosionary impact on just how much you make. And oftentimes you don't gain some of the same benefits as a foreigner that you would get as a local. So for instance, if you're a foreigner, can you take advantage, and you're investing in the US, can you take advantage of a 1031 exchange, right? That's something that Americans can take advantage of, but as a foreigner, you may not be able to, both even like in terms of locally, but in terms of where you are, right? So you may get double taxed. That's a terrible thing, right? So the question then becomes, all right, well, how do I deal with that situation, right? How do I minimize and optimize this tax? And very often it's possible to use structures to do that. So sometimes this means you can use some sort of a company. I would say that I get a lot of people who come to me who say, hey, listen, can I just form a foreign company and have it run through there and not pay the tax? Usually that doesn't work very well. And the reason for that is it's too simple, right? If it was that easy, the local tax authorities, whether it's the IRS or HMRC or the ATO or the CRA or whatever other one, would say, hey, listen, what's happening? All these people are moving abroad. They're going and they're setting up these companies. They're not paying any tax, and they'd be kind of out of business. So as a result, they've often built laws against that. Sometimes you can, and it's certainly worth looking at whether there is some simple solution like that, right? Or even whether there's some simple type of investment which will help you in that regard. That being said, the thing that often will help you is to utilize some sort of a trust structure, okay? So trust structures often are a way of getting around some of the, it's often getting around some of the management control rules, sometimes often getting around some of the controlled foreign companies rules. Now, trusts have to be very carefully structured, and I've done a bunch of videos in the past on that, but do consider that. If you're going to invest abroad, consider, okay, is there some sort of a structure I could put in place that will allow me to invest in what I'd like to invest, maximize those returns, maybe defer the tax if I can't, eliminate the tax entirely, and allow me to reinvest subsequently over and over again and compound that money, which gives me much more returns over time. So anyway, I hope that helps. If you're at all interested in learning more about that, please reach out to us. Like I said, it can be kind of complicated, and trusts are very country by country. So it's not necessarily something that works for everyone, and certainly doesn't work in the same way for everyone. Spain treats tax trusts much differently than, say, the US does, which is different than the way that Australia does. So, worth considering. But that being said, certainly there are some ways that you can do it. And even if you're not going to set up some sort of a structure, definitely think about the tax consequences of your investments and think about the after-tax return as opposed to the pre-tax return. Hope that helps. Again, if you haven't already, hit the subscribe button, hit the notification bell. I really appreciate you watching the video. Share it with your friends if it's helpful to you. Give it a thumbs up. And if you have any questions, put them in the comments below. If you'd like to reach out to me, please do. Again, link in the description below. I'm going to see you guys on the next video.